Sure. We're now going to hear a little bit about the global shipping, a global shipping markets review. Our speaker is Mr. Burak Cetinok, who's head of research at Arrow Shipbroking Group in London. And Burak, we're looking forward to hearing your comments. But I mean, I read the other day that this has probably been the most positive start to a year for many, many years. So I hope you're going to give us some good news. Burak, please.
Thank you very much for that very kind introduction, Kevin. Yes, I mean, for certain sectors, it's been the strongest start to a year in over a decade, I would say. But for certain others, obviously, it hasn't been that good, namely the tanker market. And hopefully today I will share my views about these three conventional sectors and give you our outlook for the next 12 to 18 months. Now, first of all, I will start off with a cross-sectoral comparison, and we'll try to identify the cycle position of each of these three sectors, namely dry bulk, tankers, and container ships. I will then move on and give you our outlook for the next 12 to 18 months or so, as I mentioned. Now, it normally takes about half an hour to 40 minutes to go through each of these sectors alone, but today I have half that time, but all the three sectors to go through. So I try to keep my slides as high level as possible and focused only on the key macro drivers. If the audience has any specific questions, please feel free to ask. I would be happy to address in the end. But before I kick off, I also would like to give you a quick introduction to Arrow Shipbroking Group. I'm sure some of you are already familiar with us, but Arrow is one of the largest privately owned broking companies in this industry. It was established in 1990 and headquartered in London. Since its inception, Arrow has pretty much grown, organically, and today we have more than 200 shipping professionals active in offices in 14 different countries around the world. I would say we are one of the dominant players in the dry bulk sector, active in chartering, sale and purchase, new building contracting, as well as FFA trading, forward freight agreements trading. But we also have a dedicated tanker projects team in Copenhagen, primarily active in oil products space. Now, apart from our traditional broking services, Arrow also established Arrow Capital in 2018 as our finance advisory arm. Arrow Capital is managed by well-known professionals to the ship finance industry. I believe most of you will know my colleague, Regis Kaze. Regis is a managing partner at Arrow Capital, but before that, he started financing Turkish ship owners back in the mid-1990s, first with BNP Paribas, but for decades ever since, predominantly at Credit Suisse. Now, Arrow Capital advises clients on their financing needs and offers all of its network, which includes 70 financial institutions, credit funds, as well as banks worldwide, to deliver the most appropriate solution to its clients. This includes standard debt, but also more complex financial engineering solutions, such as equity mandates, as well as mezzanine arrangements. And since inception, Arrow Capital has closed about 15 transactions, the largest ones being around $50 million mark. Now, that little introduction out the way, I'll kick off with this cross-sectoral comparison. Well, I mean, what can I say? 2020 has been a year of extremes. Soon after the outbreak, tanker earnings surged as the sharp and rapid drop in global oil consumption triggered an unprecedented rise in floating storage demand. By contrast, global consumption of consumer goods and industrial activity plunged and led to a sharp decline in containerized goods and raw material shipments. However, by mid-year, this trend was completely reversed as floating storage demand ceased, but container and bulk trade surged and triggered a rally, an impressive rally in the container ship and dry bulk sectors. Today, dry bulk and container ship earnings are more than double the level seen just before the pandemic kicked off, whereas tanker earnings are well below those levels. Now, if I were to locate the position of each of these sectors in the current shipping cycle, I would say the bulkers are at mid-cycle. China was the primary driver of growth last year, but we are now seeing the rest of the world coming back to life as well and contributing to that rapid growth that we are seeing in dry bulk shipments. And for that reason, we are seeing it's mid-cycle. We see further upside. Containers could also be identified as in mid-cycle, but probably a little closer to the peak, I would say. That doesn't necessarily mean we expect container ship earnings to decline anytime soon, but I would say it feels a little bit closer to the peak. And tankers are probably at the trough. The worst seems to be over, but the climb back up to the pre-pandemic levels is likely to be long and quite uneven. Now, if you are to focus on each of these sectors, kicking off with the dry bulk sector, as you said, Kevin, I mean, the dry bulk sector has enjoyed the strongest, sorry, I somehow lost my slides. Yes, the dry bulk sector has been enjoying the best start to a year in over a decade. While rates somewhat softened for smaller vessels in recent weeks, they remain comfortably above the seasonal average levels. Now, temporary disruptions, predominantly, triggered by adverse weather conditions, as well as, high congestion, definitely played a part in the recent rally. But we believe that improving fundamentals are the primary driver behind this strength. This table shows the year-on-year change in dry bulk exports, and you can see since the end of last year, we've started seeing a material improvement in shipment volumes. And as we moved further into Q1 this year, volumes really increased. And we currently estimate that the global dry bulk shipments were up by 7.6% in the first quarter of this year. Now, obviously, there are some base effects this year because in first quarter of last year, we saw that the impact of the pandemic being felt in the dry bulk sector. But even then, if you compare the first quarter this year volumes to the pre-pandemic levels, they are very strong. They are well above the levels that we normally see around this time of the year. And we expect this strength to extend well into 2021. As I mentioned, China was the primary driver of dry bulk seaborne trade in 2020. The natural question is whether if it can sustain that growth momentum. We believe it will, especially in the first half of this year. We believe Chinese demand will remain very strong, but towards the end of the year, it's likely to switch engines. What I mean by that is, shortly after the Chinese government introduced its stimulus program in May 2020, we've seen a very rapid rebound in infrastructure and property sectors. And these two sectors are critical for China's dry bulk demand. They account for about 60 to 65% of steel demand combined. So anytime that these sectors do well, Chinese imports actually grow rapidly. By contrast, manufacturing was actually lagging a little bit. But what we expect this year is in the second half, towards the end of the year, we expect infrastructure and property to slow down somewhat, but manufacturing to pick up. And earlier has indicators that we are getting out of China suggests that demand remains extremely strong, both in the infrastructure investments or fixed asset investments, but also in the property sector. That should keep Chinese demand at very healthy levels, especially in the first half. But it's not just about China anymore. The global industrial production is surging as the rest of the world is recovering and coming back to life, and the recovery is expected to accelerate in the coming months. This chart shows global manufacturing PMI output index, and it plotted against industrial production. As you can see, global industrial production has been rebounding already, but it really accelerated at the beginning of this year. Now, one interesting or critical point to mention here is the global manufacturing sub indices, or new orders sub index, if you like. New orders index have been improving very strongly, and it suggests manufacturing output is going to increase in the coming months to match this demand coming from the new orders. There's usually about 2 to 3 months delay from the moment that new orders show strong push, and that strong demand is reflected on manufacturing output. So overall, if you look at the demand side of things, the dry bulk market is in a very good position. We expect dry bulk demand to remain extremely healthy, at least for the next 12 months or so. On the supply side, things are looking quite healthy as well. We are seeing deliveries slowing down and an order book shrinking. This actually slide is an interesting one. It's an observation rather than an analysis. It gives a quick review of the dry bulk sector supply metrics last year. And you can see deliveries were really high last year. We've had almost 50 million deadweight tons delivering, but contracting actually slowed quite sharply. And that led to a very rapid shrinking of the order book. Demolition was also really high, so fleet growth also moderated. And this is interesting though, because almost 4 times as much ship capacity was delivered last year than contracted. And it happened twice over the last decade, in 2012 and 2016. And on both occasions, the Baltic Dry Index increased in the subsequent year, 31% in 2013 and 70% in 2017. And if you look at the macroeconomic backdrop in those years and the macroeconomic environment right now, they're very similar as well, because in 2012, the global economy was coming off from another slowdown, and China was stimulating again. In 2016, the global economy was recovering from a mid-cycle slowdown, if you like, and again China was stimulating. And today we are seeing early signs of global economy recovering and China stimulating again. So it's, I think, reasonable to expect, even from this perspective, to have a strong dry bulk performance in 2021. As I mentioned, order book is shrinking very rapidly. In fact, the dry bulk order book is at its lowest level in over 25 years. Currently, only about 5.76% of the fleet is on order, and that means deliveries will slow down quite substantially. Now, we are seeing contracting picking up again. We've counted about 100 dry bulk carriers being ordered so far in the first quarter of this year. That's quite significant number, but those vessels will not deliver until very late 2022, and mostly in 2023. So we've got a very good visual of the supply side, and it is looking rather positive. So coupled with strong growth in seaborne trade, we expect dry bulk earnings to recover quite nicely. We expect them to remain very firm. This year we expect dry bulk trade to grow by at least about 5%. Now, this is looking rather conservative based on the first quarter figures. And by contrast, we expect dry bulk fleet growth to slow down from about 4% last year to about 2.5%. Fleet growth is likely to extend well into 2022. We expect at max 1.8% growth in dry bulk fleet. By contrast, we foresee dry bulk seaborne trade to continue to grow at above average levels, or around 3%. So with that tightening of the market, with that narrowing gap between supply and demand in the dry bulk space, we expect rates to remain healthy across the board, to be honest. Moving on to the tanker sector. Well, the tanker sector, tanker market has experienced extreme volatility in 2020. First, that surge in global floating storage demand pushed tanker earnings, to record highs almost indiscriminately. We've seen all, segments breaking records. But by June, July, that, trend actually completely turned around, inverted, and as floating storage demand ceased and vessels started delivering back into active trading fleets, they faced a very uncertain and very weak demand environment, and rates collapsed. And despite the recovery in global oil demand over the last 6 or 9 months, let's say, the tanker market remains structurally oversupplied. These two charts may be a little bit too simplistic. I might have overgeneralized things a little bit, but I think under certain conditions, it's good to have a look at the big picture. The chart on the left-hand side shows global total liquid supply, total crude oil and product supply to the market. And the chart on the right-hand side shows global tanker fleet, again, crude plus product fleet. And you can see current liquid supply is roughly about 7% below the levels that we've seen just before the pandemic started. Whereas the tanker fleet, combined tanker fleet, is about 4% larger than it was back then. So with this widening of the supply-demand gap, tanker rates are under pressure, and we expect this to be the case in the near term. Now, you might actually consider question, yes, but was the market balanced back in 2019, at the end of 2019? It was actually a very good time to compare, because it was actually quite a balanced market back then. So it's actually a reasonably good comparison of market conditions, if you like. Now, what's the path ahead? Then, well, it's the oil market is still facing quite a lot of headwinds. There's still quite a lot of uncertainties around, and I tried to simplify it and tried to create this framework, if you like. And I broke down the path, the tanker recovery, to 4 different phases. The first phase is oil demand recovery, then followed by inventory normalization, and then it comes the increase in global supply of crude oil and products, and finally tanker market recovery. Now, good news is that we are already well into phase 1 and 2. Oil demand has been recovering, since the end of Q2 last year. Inventory normalization is well underway. Inventories have been falling since August last year. But supply in global, crude oil and products market will lag a little bit. In terms of oil demand, with the recent increase in infection rates in certain parts of the world, the outlook for the recovery in oil demand still remains quite uncertain. Transportation demand is key, because transportation sector accounts for about 60% of global oil demand. While we are seeing people driving a lot more and industrial activity consuming a lot more diesel, jet fuel demand is very weak, and it's unlikely to recover very rapidly. That will act as the main drag on global oil demand recovery, if you like. In the inventory normalization, well, it's well underway. As I said, floating storage is mostly unwound. Onshore stocks are still high, but we expect the stock drawdown to accelerate in the second half of the year, and that should bode well in terms of inventory normalization. Once inventory normalization is complete, any increase in demand will be met by rising production, and that's when we should start seeing tanker markets really, moving upwards, if you like. Until then, any increase in output is likely to be marginal, as we've seen from the OPEC Plus reaction to the developments in the oil market. The good news is that in their recent meeting, they pledged to increase crude oil production by about 2 million barrels per day by the end of July. Now, that should bode well, but even after that increase, supplies will remain well below the pre-pandemic levels. Then the 4th stage is tanker market recovery. Well, limited fleet growth will be key to restore the supply-demand balance, in my view. The good news is that order book is quite small, but it's front-heavy. Most of the ships that are on the order book will deliver in 2021. Another good news is that fleet is aging, and we anticipate fleet demolition activity to increase in coming months, and that should support or accelerate the recovery in the tanker market. Let's back this argument up with a couple of charts, if you like. Excuse me. Demand recovery, as we said, demand recovery is well underway, and we expect the recovery to pick up in pace in the second half of this year as containment measures are eased. We expect this to happen in Q2 onwards. I mean, I'm based in London. On Monday this week, the lockdowns were eased. The difference is day and night. I mean, people are out and about, they are busy, having fun at pubs and restaurants. And I can physically see the difference between last week and this week. So as vaccinations, rollout or vaccination rollouts gather pace in the rest of the world, we expect the same to happen elsewhere, and that should bode well for global oil demand. In terms of inventory normalization, we mentioned that floating storages is pretty much unwound. They've declined quite steadily since middle of last year. They're only above the long-term, slightly above the long-term average levels. In terms of oil stocks, onshore oil stocks, they've been declining steadily since August last year as well, but they are still above long-term average levels, and we expect that normalization to pick up in pace in the second half. And by some time, in the second half, we expect this inventory normalization to be over, probably towards the end of the year, and that will be the first time that we should expect a more sustainable and meaningful recovery in the tanker markets. In terms of supply recovery, well, it's very difficult to predict because there's a lot of geopolitics involved, as well as pricing mechanisms have an impact on when supply will come online. But with the uncertainty around the demand recovery, global oil production is unlikely to increase, very rapidly, and we expect global oil production levels to, reach the pre-pandemic levels sometime around mid next year, late 2022. Of course, we could be wrong, but this is our current expectation. How about the tonnage supply? Well, as I said, there are good news and there are bad news. Starting off with the bad news is that the tanker order book is very heavily front-loaded, which means most of the ships that are on order will deliver this year during when we expect demand to remain quite weak. So from a macro perspective, that should keep a lid on any meaningful gains in tanker earnings across the board. The good news is there are two. First of all, the order book is very small, and they're only above, historical lows, record lows, if you like. About 10% of the crude oil tanker fleet is on order currently, and only about 6.4% of the product fleet is in order. And the other thing is, as I mentioned, fleet is aging very rapidly, especially in the crude oil sector. About 27% of the crude oil tankers are above 25 years of age. 15 years of age, and they will be facing increasingly strong scrapping pressures during the rest of this year, especially given the strong steel prices that we are seeing at the moment and the depressed freight market. We expect tanker demolition to increase quite meaningfully this year, and that should accelerate the rebalancing of the tanker market moving forward. Now, the product fleet is obviously it's a lot younger. Only about 6% of the product tanker fleet is above 20 years of age or overaged. The good news about the product side is its order book is actually very slow. It's at its lowest level on record. Only about 6% of the current fleet is on order, and it barely covers the fleet renewal requirements over the next few years. Again, that's a positive for the tanker market recovery moving forward. So overall, if I am to wrap up the tanker side, there's no question that that headwinds persist both on the product and the crude oil side. Demand is very uncertain, and the recovery is likely to be long and bumpy. But at least on the supply side, things are improving and are improving quite rapidly. And hopefully by 2022, probably in my gut feel about mid next year, we should start seeing tanker earnings recovering quite meaningfully. And I know I'm running out of time. I'm moving on to the container ship sector. I'll very rapidly go through a few slides. Now, the container ship sector has seen the perfect storm, I would say. I mean, it's seen the storm. It's even crazier than the 2007-8 period, if you like. Everything that could possibly go right has gone phenomenally well for the sector over the past year or so. Freight rates are still at record highs, driven by demand from e-commerce. restocking and congestion along the entire supply chain. And the recent closure of the Suez Canal only poured fuel onto the fire. So given the still high infection rates in many parts of the world, we believe the drivers behind the strength in the container ship sector to remain in place for most of this year. And we expect, for that reason, we expect the strong rate environment in container markets to extend well into the second half of this year, only to soften slightly in 2022. Now, let's have a quick review of trade flows. Global container trade dipped very sharply in first half, but volumes bounced back strongly since Q3, mainly driven by strong demand in the e-commerce. This includes everything from unnecessary purchases, as I'm sure this resonates well with some of you. I mean, I've been ordering weird stuff on Amazon past 12 months, but also from demand for stay-at-home goods like computers and microphones and all sorts of different things. So this pushed shipments from Asia to the Western world and lifted container ship volumes. Another shift from the PPE supply chains from air to ocean freight also supported this strong growth. On the supply side, supply side was very rapid to react to changing demand landscape as well. Consolidation, mega alliances, and low order book enabled the sector to swiftly rationalize capacity, and this helped to restore supply-demand balance very quickly. The chart on the left-hand side actually shows top 10 carriers, fleet evolution, and market share over the years, and you can see how the top carriers increased their market share and grabbed that sector, the control of that sector very firmly since then. In 2016, they accounted for just above 60% of the market share, but that climbed up to about 85% of market share by the end of last year. With so much control under their hands, obviously they were very easy and very rapid to rationalize capacity. Idle fleet went up very strongly. A lot of capacity was idled very rapidly last year, but as soon as demand came back online, fleet was reactivated, and now only about 1% of the container fleet is currently idled, and that's supporting, even with such active capacity, container rates are still at record highs. And as I mentioned, this will continue to support this will continue to be the case, at least in the near term. We still expect container demand to remain very high, and that should keep freight rates very high. I mean, just to put things into perspective and just to paint a picture of how crazy the container market is right now, on average, shippers are paying about $6,000 per TEU to ship goods from Asia to North America. Now, some of these giant ships, like the one that got stuck in Suez Canal past few weeks ago, they carry about 20,000 TEUs. That means $130 million of gross revenues per leg. I mean, that's an insane number. That's how crazy the container market is right now, and that is obviously reflected on time charter rates as well. Tonnage availability in the period markets remains very tight, and time charter rates are near record highs. Even though we expect fleet growth to actually to increase this year, especially in the second half of this year, as more deliveries are joining the fleet, it's going to be very strong, because the market is going to be very strong, because we expect trade growth to continue to outpace the growth in active capacity. We expect global container ship trade to expand by almost 5.5%, whereas active fleet is likely to grow by about 4.5%. Next year, we expect fleet trade growth to slow down slightly, but so will active capacity growth. So with very tight supply-demand balance, we expect the container ship market to remain very firm. So that brings me to the end of my presentation. I think I'm not going to read through this. I think I've already overrun my time, But with one word, I'm bullish dry bulk market. I'm optimistic about tanker market, and I'm very bullish about the container market moving forward. And if there are any questions, Kevin, please feel free.
Yep. Burak, yeah, thank you very much. Very interesting presentation. We apologize for the technical hiccup, but we recovered very well, so that's great. A couple of questions did come in.
Yes.
Actually, one was in respect of, for the last few years, there's been a talk of more regionalization, rather like the whole globalization thing may be coming to a halt, and there's going to be more regionalization with intra-Asian trade and all the rest of it. Has that changed at all because of COVID? Is globalization still kind of number one?
Well, yes. I mean, it definitely increased its importance. I mean, especially not the pandemic only contributed to an already existing trend, I would say. I think this really started when the global trade tensions begin between China and the US. The US suddenly really realized how much they depended on China for manufactured goods and for their own industry, and that triggered some sort of an unease between the developed economies, because the same sort of supply chains are in place. So it did, short answer, it did definitely increase that focus on deglobalization, but these are mega trends, and global industry still very much depends on Asia for its manufacturing capacity, and these changes will take a long time to take place. So yes, okay. It has increased importance, but its impact will take a long time to be.
Okay, very good. Another one on, generally speaking, when markets are good, owners are not very disciplined and they go out and order ships. You mentioned that it looks okay for the next 1.5 years because the yards are full up. But I mean, is it a danger that like 2 to 3 years out, the party may be spoiled by too much ordering in the next 12 months?
Well, there's always that risk, because ship owners, as we all know, they can make, over enthusiastic investments from time to time. We've seen this repeating itself. But I think, dare I say, things are slightly different this time around, because technological and regulatory uncertainties seem to be keeping a lid on ordering activity. Because we are in this gray zone, if you like. No one really wants to order a technology, a shipment technology that may become obsolete over the next 5 to 6 years, but also no one really wants to be the last, and also at the same time, no one really wants to be the first, first to order the new technology. So these regulated technological uncertainties, if you like, and the lack of clear solution, long-term solution at the moment, is keeping a lid on ordering activity. So I believe we will see year-on-year increase in ordering, especially in cargo and containers, but historically speaking, they will still be at lower levels.
Okay, perfect. And just a final question before we end. Your presentation makes clear that the containers and dry look pretty good, and tankers have good prospects going into next year probably. Are there any dark clouds on the horizon? Can you identify anything that sort of may change that positive story?
Well, I mean, I think for dry cargo, I think China is still by far the biggest risk factor. Even though it's the biggest driver, it still is the biggest risk factor, because there are a lot of politics involved, which could impact Chinese demand. Now, one risk that I see is of course, Chinese economy did extremely well over the last 12 months. It improved or recovered much faster than many people expected, and that could lead policymakers in Beijing to actually taper the stimulus prematurely or quite sharply. That could have a significant impact on China's dry bulk imports. That said, part of that would be offset by the recovery that we are seeing elsewhere. So that's one thing. Secondly, another thing is, again, in China, I would say, environmental policies are changing by the day. There's no doubt, Chinese policymakers are focusing on environmental protection much more than they did in the past, and they are not afraid to take drastic actions when it's needed. and this could have an impact on their steel production moving forward this year. And again, it could impact demand. But then on the other hand, their demand for grains, and not just China's, but also elsewhere in the world, concerns about food security is fueling grain trade. So yes, there are certain risk factors, but overall, when we put them on a balance, on a scale, I think positives outweigh the negatives. Containers, to be honest, I can't really think of anything that could go wrong right now, because Western world, Western
That's
industry.
perfect, and I think that exactly. Okay, that's great. I think that's a good place to stop. That there's mostly positive news, at least for the next for this year at least. So that's great. Burak, thank you very much for your presentation. I apologize to you and to everyone else again for the technical hiccup, but thank you very much. And again, with you and with as we mentioned to Mr. Kiran and everybody else, if we manage to do something in Turkey next year, then we hope you'll be able to come and present live in Istanbul. That would be great.
I would love to do that, Kevin. As you know, Istanbul is my hometown, and I haven't been there for a while because of the pandemic, so I can't wait if there's the invitation.
Perfect. Okay, so that's the end of session 1 of our Marine Money Istanbul Virtual Forum for this year. If you'd like to join us again in 45 minutes or 40 minutes now, we go into session 2, and session 2 discusses macro issues affecting shipping in Turkey and the world. We look forward to seeing you in 40 minutes. Thank you.